While stock markets often steal the spotlight during periods of economic uncertainty, it's the bond market that has taken center stage on Wall Street this Wednesday. In a surprising twist, U.S. Treasury prices are falling sharply, causing yields to surge, a move that defies the usual market playbook when recession fears are on the rise. Typically, fixed-income securities like Treasuries are seen as safe havens in volatile times. But this week, the bond market is telling a different story. The yield on the benchmark 10-year U.S. Treasury note soared by 11 basis points, reaching 4.37% and briefly topped 4.51% overnight, marking a significant spike in a short time. This level pushes yields higher than they were just before former President Donald Trump's tariff announcement last Wednesday, and it's now the highest point seen since February. Just days ago, this same yield was comfortably under 3.9%, highlighting how fast sentiment in the bond market can shift. The 10-year yield is particularly important because it serves as a key reference for a wide array of consumer borrowing costs, including mortgages, credit card interest, and car loans. Meanwhile, the 30-year Treasury bond, another critical gauge of long-term investor expectations, hit 5.02% overnight, a level last witnessed in November 2023. That's a considerable jump for a market typically known for slower, steadier moves. The 2-year Treasury yield, which is more sensitive to near-term monetary policy expectations, also edged higher by 2 basis points, now sitting at 3.76%. For context, 1 basis point equals 0.01%, and it's important to remember that bond yields and bond prices move inversely, meaning that as prices fall, yields rise. This recent bond market behavior raises several red flags for investors and economists. First, it could signal growing uncertainty about the path of interest rates, inflation, and Federal Reserve policy. Second, these moves may indicate that investors are losing confidence in bonds as a shelter amid broader economic storms, which is a stark deviation from historical norms. Some analysts believe that higher yields reflect market concern over persistent inflation and the possibility of prolonged high interest rates, while others view it as a response to growing fiscal deficits and increasing Treasury issuance. What's clear is that the bond market is currently setting the tone for Wall Street, not the stock indexes. And when Treasury yields are this volatile, it often sends ripple effects through virtually every corner of the financial world, from equity valuations to corporate borrowing costs, to global currency movements.